So we're going to talk about Parker will fill us in on the history of challenges as he's on the ground operator at FTW. And we're going to talk about the project status and then talk about the plan forward and the capital plans and the needs going forward. And then we'll talk to some of the financial assumptions we've made. We're joined by also Mark Riesman, who's our Touzi Capital's asset manager. Hello. All right, Parker, you want to kick it off?
Yeah, absolutely. So Stoneybrook Towers has faced a number of challenges kind of throughout our period of ownership and operating the property that we want to share here and kind of go through each of these, a number of which could be labeled as leaks. We've had leaks from the roof that caused some damage to the 10th floor, which required us to evacuate the 10th floor, relocate those tenants. The HVAC systems, all the air handlers in every unit were leaking actively into the building. And so we had to initiate a repair to those that has since been done. Our lender was slow to release some repairs. We had some issues there that we can get into there, but one of them was that despite the seller signing an affidavit, there was a lien placed on the property closely after closing from one of their vendors. And so that had to be resolved amongst a few other things that have meant that the lender's been slow to release reserves that we've needed to run the project. One of the leaking issues that we've also had is plumbing and jetting lines. So the stacks in the property have presented some problems for us. And so we engaged a contractor to do some work there. And unfortunately, they violated the scope of work that we provided, which caused some leaks and flooding to the lower level and some damage to the vertical stacks, which have since been repaired. But again, just another issue. This also caused some flooding, which damaged a number of units throughout the property. The boiler and chiller system, despite the seller having made some repairs to this and bringing it into usable condition prior to closing, has presented some issues. It's an older system, and we've had a lot of repairs that have had to be done to the boiler and chiller system. This controls the hot water for the building, it controls the hot air and the cool air. And so this has been a big piece there. On the garage, we've recently seen some structural degradation there, where some structural reinforced pipe or some structural cement has degraded from some drainage, and we're currently having this assessed by a structural engineer. We've been through 2-3 property management changes. So we originally had Atlas Property Management on the site, and then we transitioned to Clemens Property Management. And then finally, earlier this year, we transitioned to Tango Property Management, which is an FTW affiliate, earlier this year to really kind of take control. What we were not getting from our prior property managers was data integrity and making sure that the financial accuracy was there. And so it just took a lot of work to move those things through. And then B, there was just a failure of execution on standard property management procedures. So this would be unit turns, common area maintenance, just standard things that weren't getting done into a standard, and leasing and collections lapsed because of that. So this is the reason why we've made some of these changes, and the reason we eventually have brought it in-house, where we've been substantially focused on unit renovations and leasing and collections efforts. And as part of that, cash flow has been an issue. So, tenant culture has been an issue since really COVID. We've had an issue with payment and some of those things, but fortunately through Tango Property Management, we have some pretty substantial relationships with government agencies like ERAP and SAFER, who've been able to provide tenant rent relief. So that's been a huge help and has allowed Tango to really substantially reduce the back due rent from our existing residents. And so that's still been an issue. And right now, our biggest issue when it comes to cash flow is really finishing out units and leasing up the spaces.
Yeah, thank you, Parker. Just to add a little extra color, the initial part of this where there were, with the lender not releasing funds and then the additional surprises that came, we weren't able to get ahead. We weren't able to, it was distracting from doing the initial business plan. So the longer that the initial business plan wasn't started, because we were chasing all this new stuff, just kept setting us back. So here we are today. We've addressed most of the emergencies there's still some bigger open items that we'll get into shortly, but there is progress. It's just that there's a lot more to do, and the lender slowing us down initially was tough.
Yeah, and from a cash flow and cash flow planning standpoint, it makes it difficult to address these items and get right back to stuff when we're kind of fighting to get paid, so to speak. But when it comes to the roof, we're able to address these issues in a series of ways. One of which is we applied a new layer of roof to this roof. So we've done some patch repair and also applied a whole new entire layer across the entire roof. And so that roof is now airtight. We relocated those 10th floor units and have a contractor engaged to currently rebuild those units that were damaged. HVAC condensation. So the solution that we employed here is we are actually able to pipe the water out of the building. I think we've had so many issues when it comes to leaking in the building that we wanted to make sure we're getting as much water out of the building as humanly possible. We didn't want any more degradation and certainly no more damage internally, because that obviously puts everything behind schedule. Lender has released a number of our reserves. We're still waiting on a few that are really tied to the work that we're actively doing today. And so we expect them, and we've been working with them hand in hand. There was some changeover at our lender that it ended up with multiple months of delays. Now we've got a crew that we're working with at Arbor who's doing a good job working with us, and they've been open. They've come out. We toured the property with them a few weeks ago. They're aware of the challenges we're dealing with as well as what we're doing to fix them. And so we're working much more hand in hand with that group. Plumbing and jetting lines. So again, when we completed the scope of work to clear the lines out, it was violated. They're supposed to start on the ground floor. They started on the top floor, which is exactly what we wanted them not to do. And so that they applied pressure there. So what happened was we had burst pipes underground. We replaced those pipes with the damage that happened to the ground floor. We submitted that as an insurance claim. One of the 3 claims associated with that was approved. The other 2 were denied. We're currently pushing back on that to dispute those denials, and also are exploring a direct claim against the contractor who did the work as well. Initially, in our conversation with our insurance agency, the plan was to submit to them, allow them to subrogate the claim against the contractor. And now we're sort of looking at, the option of a claim against them directly. Boiler chiller. So we've made a number of repairs to the boiler, the chiller. We just had our biannual inspection of the boiler, made the repairs that were associated with that. There are still some additional repairs that are necessary. And ultimately the system is older. And so we're continuing to make repairs as necessary. But eventually a full replacement of these systems will be required. And so we're exploring what that looks like. But as of right now, what we've been doing is making the repairs that are required to get the systems that we have in place working and functioning. As I mentioned on the garage, we have an engineer who's been engaged to do a structural assessment of the garage so that we can have a plan for any immediate repairs required, as well as an ongoing maintenance plan. And then property management changes. So Tango's now in control, financial reporting, day-to-day operations management have been dramatically improved. I got a very nice 5-star review today from a new resident at the property. But our largest focus today has been on completing unit turns, collections, and leasing.
Thanks, Mark, for that history of challenges. How many of these challenges were known, or I guess were surprises when we took over?
Yeah, I mean, just about all of them were. We knew that the HVAC system was older, but based on the assessment that we had done at the time, this was something that was deemed, a standard maintenance plan in place would be able to keep this system going for, 10 plus years. It's since, not shown to be the case. And so the repairs required have been more substantial than we initially knew. Everything else really on this list is brand new. And so these are all things that we've had to kind of jump into figuring out after the fact. When it comes to the garage, there was some work that we needed to do to the garage that we were made aware of in the beginning. This work was a required under repair that we completed already. We completed it pretty quickly back in 2021. But kind of the additional damage that's happened, kind of the degradation which has happened from basically water seeping through the permeable surface, that was sort of an unknown at the time that we bought the property.
Thanks for that. And if anyone have any questions, just add it in the Q&A chat box. We'll have Q&A at the end. So let's talk about the plan going forward.
Yeah, so currently what our plan is to complete unit turns. So this is where we're showing the highest, return on our investment. So other than dealing with major CapEx issues, what we've shown is, as we're going through and completing unit turns, which are look really nice for doing, LVP, painting cabinets, new countertops, new light fixtures, new plumbing fixtures, new appliances. And in that, we've been able to get a pretty substantial rental rate increase. And so we're already getting rents that are at towers 3 to 6% higher than our pro forma projections, and at Stoneybrook 8 to 9% higher. So the rental rates are trending very well, especially considering that market rental rates for our peer properties are actually 16% higher even than our current targets. And so what we intend to do is complete the unit turns. We're still going to scope the garage and figure out what that is. We're going to do boiler and chiller repairs as we make a kind of long-term capital assessment on what the long-term needs are for the boiler and chiller. And then we're going to make some upgrades to the common areas to make sure that we can get more people through the common areas. Them being upgraded is going to be a huge component of what allows us to go get to that extra 16% of the market sing. And so that's really a part of the plan today. We're talking about here a plan to likely list the property sooner than later. And I want to put a caveat to that, which is to say that Stoneybrook itself, as this is two properties, Stoneybrook and Independence Towers, Stoneybrook itself, we're renovating units right now as well. I think we have 11 more units to complete at Stoneybrook. When we renovate those units, Stoneybrook's getting a very high premium on its rental rates. And I think there's even more room to grow there. So I think Stoneybrook itself is going to be in a position to sell likely sooner than Independence Towers. But Independence Towers, we're going to work towards that resolution as well. I think the biggest issue that we have in kind of getting Independence Towers to a sale is just making sure that we can get a really strong T3 and a Y that can attract a buyer for that project. Stoneybrook, because of its size and nature, I think we can sell that individually to someone who's going to like that project, like the rental upside, like the ability to manage that project specifically. So while we're talking about here the potential opportunity of selling both properties in 2023, I think in all likelihood, Stoneybrook is certainly going to be able to execute on that timeline. Independence Towers, we're going to work diligently towards that result, but that result might require, or that project might require more time, a little more seasoning to push value in the property to get the most value out of the sale.
Thanks for that. Okay, so obviously we're here because there's a lot of challenges and it requires some capital. Can we talk about the capital plan and at a high level, the project requires 4 things, which is capital, construction, leasing and collections, and sales execution. So in each of those things, the capital side of the equation is our current estimate for all current capital needs is $600,000 of additional capital required for this project. This does not include allowances for the garage or HVAC replacement, or includes the repairs that are required to the current HVAC. It includes the assessment for the garage, but it does not include major repairs to the garage or major repairs to the HVAC systems. From there, construction, we have to go execute on the construction side of this. And so Tango Management has engaged 2 contractors today to work on this. And so Oakmont has been doing all of our unit turns and renovations. Really, these are renovations. We're having to renovate these units in order to get maximum value. And then Repairs Unlimited Inc. is a local company that specializes in working with insurance companies on insurance claims. And working with property owners to basically navigate those claims. They've been engaged on the insurance claims that we have there. They're working with us to dispute the 2 denied claims, as well as working on the 2 approved claims and commencing the work on those. So leasing and collections, obviously, once we have units ready, we have to lease those units. And so as we're seeing units as they're fully ready, with our biggest delay in that being appliances and back order on appliances, as soon as these units are ready, we're seeing pretty strong leasing activity. So anywhere from 10 to 15 new leads a week for each property are actually coming through, which converts to about 2 to 4 applications per week for each property. So we're seeing pretty strong interest in the market in the properties. So really, once we get these properties ready, that's been the huge focus, which is capital and construction, then it's leasing and collection. So
Collections, again, as I've mentioned, there's been a general pervasive issue on collections and post-COVID. And this post-COVID environment, where for the longest time we had, eviction moratoriums and things like that, there's really a cultural issue that created, where people didn't feel like they needed to pay their rent. And so it's been a big effort. We've been able to use ERAP and SAFER to close that gap. And ERAP and SAFER are two programs that are starting to run out of both capital and time. And so really just pressing on the cultural component of ensuring high collection rates, ensuring people are doing that. And there's a few other ways that we're dealing with that as well. And so some of that is through our relationship with other housing agencies, whether that be locally Kansas City Housing Agency, Kansas City Independence, Restart Saving, Truman/University Health. Those are also groups that we've been talking to, as well as the Veterans Affairs, for both master leasing opportunities, where these agencies can master lease, sometimes, they'll master lease 1 to 10 a piece, plus the collection side. So some of them are helping residents that have needs that meet their program criteria. Others are helping them get the lease and are backing the lease with government funds. And so those are kind of two ways that we're attacking that from the housing agency side, but we're also getting a lot of market interest. And then sales execution. So what our process is going to be on sales execution, once we've infused the capital that's necessary to complete the project, complete the construction, and lease this project, and make sure we have high collections rates. Then from there, we need to execute on the sale. And the sale is going to look like, we're going to take it to 3 reputable brokers in Kansas City. These are groups we've already worked with. We've had one of them already look at the assignment, listed the assignment, and wasn't able to perform. However, that was due to a number of factors that are really the ones we're talking about here today. So we'll get 3 brokers' opinions of value, have them assess the properties, what valuation they believe they can go out and execute the marketplace on, and then we'll pick a broker who's going to be the best one to go take the properties to market. Once we have that strategy, it's going to be about making sure that we can do the transaction management that's required to get this thing sold. So I'd say of the 4 areas, we feel confident that on the construction, leasing, and collections and sales execution side, we have teams in place. We're working through strategies and tactics to execute on those. And the biggest need that we're really talking about today is on the capital side of the equation.
In terms of sales execution, are we looking at selling individually Stoneybrook apartments and Independence Towers?
Yeah, we're likely going to look at both. So we're going to look at the opportunity to sell one or the other. I do believe that Stoneybrook is going to be ready sooner, and I do think it's better for the overall portfolio that as soon as one of these is ready to sell, I think that creates a cash event where we can have additional cash to deal with anything that we might need to deal with in the property, as well as the opportunity to return capital to our investors. And so while we will explore that, kind of depending on how the timing works out on the construction side of things and the leasing side of things, I think it's probably going to be Stoneybrook first, then probably Towers. Although if we time it, there are some buyers out there that would like both. I will say in our general conversations with the marketplace, I do think that we probably have 2 separate kind of buyer avatars for each property, where there's probably a different pool of buyers for Stoneybrook, a different pool of buyers for Towers, and then a different pool of buyers for both. And I believe that executing on them individually is going to produce the maximum result.
That makes sense. So let's talk about the capital plans and the timing. So we've thought about this. Yeah, go ahead.
I'm saying, and if you want to, chime in here as well, but I can kick us off if you'd like.
Yeah.
So we are, of this, we're looking at a number of different ways to solve the capital problem. The first of which is that Touzi and FTW have deferred fees on the project, so we're not currently collecting fees on the project. In the case of FTW as well, with our affiliate Tango, we've actually been deferring property management fees. That cannot go on forever, as it's tied directly to both salaries, reimbursements, and property management fees. But we've been deferring those fees. And additionally, FTW and Touzi have loaned the project $110,000 to make good on some of the capital needs that it has had so far. So from there, what are we looking at? There's a few different options here. So pref mezz financing or hard money loans. There are some opportunities there that we're exploring. The opportunities are limited. They present problems. They present a number of problems. One of which is, this is it's dilution and or really kind of moving investors in a riskier position in the capital stack. It also present some issues with our Fannie Mae loan, as Fannie Mae will likely not approve any of this at the Independence Towers entity level, which is 728 North Jennings, or at the holdco level, which complicates our ability to execute on this as a strategy. So what that follows up with is really a capital infusion from current investors and or a formal capital call. So we do have a provision within the operating agreement for capital calls, but prior to that, what we are looking to do is say, to each investor, here is kind of where we are, here's the data points, here's where we're headed and what we're trying to do with the project, and kind of assess what that looks like. At the end of the day, the project is going to require more capital to get itself into a position where we can effectively protect capital and go out and try to get a good return on this project. There's an opportunity to always bring in new capital from outside sources. I think in this case, that one's going to be difficult to effect, but that is something that we could look at. This again, something that's going to cause dilution for the existing investors, but that is something that's on the table. And then a refi or sale, whole or in part. So we do have debt financing lockout on Stoneybrook till 2025, lockout till 2030 on Independence Towers. The rates that we have are very attractive. The loan structures are very attractive. However, because rental rates or interest rates have increased pretty rapidly, our prepay penalty on our Fannie Mae loan is very low. So one solution could be to go out and get a construction loan, take that loan out, go out and get new capital. Again, I think with some of the issues that we have, it's going to be a difficult one to effectively execute on. And additionally, with interest rates double what we have on these projects, that capital is also going to be incredibly expensive, which is also going to overburden the operating cash flow on the properties. So this is a potential opportunity, but at Independence Towers, there is some difficulty. At Stoneybrook, again, we could finish those units that we have available, get that leasing up, seek a new appraisal and refinance. That is something that we've discussed doing. Another option would be to sell Stoneybrook. So if we can effectively execute on Stoneybrook faster, it has fewer problems, it's a cleaner deal to go out and sell, then we could sell that property and use some of those proceeds going forward. However, the capital is going to be required to get the property, even Stoneybrook, from here to any sort of refi or sale. There's going to be capital required prior to being able to go out and execute on that. And I think barring one of the capital, infusion options, above, if we cannot, if we are not able to get the capital in to complete the project as necessary, that we would be forced into a position to sell a distressed asset. And that's not ideal. There is still meat on the bones. There is still an opportunity to go out and get a return here. There is an opportunity for us to protect and preserve capital. And so that's our first, our first efforts are going to be around those. But in the end, if we weren't able to have the capital in place, this would put us in a position that we don't want to be in, which is being a distressed seller.
So I think from my perspective, we've done a lot of work. Parker and his team has done a lot of work to get us out of these initial challenges and hurdles, but we need capital to get to the finish line. The lender still has is still holding our funds as part of capital improvements we need to make. And I think Parker, you're closer to the market in Kansas City day to day. An asset like this that has had all these issues fixed, where there's occupancy at market or better. How are those trading right now?
Yeah, I mean, in Kansas City, if you've got a well occupied, 90% plus occupied, where a lot of the major capital areas that we've been already repairing on this project have been completed, we're still seeing cap rates in the 4s and low 5s. So projects are still trading at great cap rates. We modeled out a 6 on this on a go-forward basis, but the demand for multifamily projects is still incredibly high. And I think once these issues are resolved and we can make a claim to a buyer that we've effectively spent $1 to $2 million on capital improvements in this property, that buyer is going to look really favorably upon
that. So let's talk about timing. Obviously, we've been working behind the scenes on finding capital for quite a while. There are some challenges to finding new investment capital or mezz and pref equity capital. That would so I think a probable outcome potentially is a capital call from investors. And we've done the math. It looks like essentially a 21% incremental capital from each investor, if every investor were going to provide capital for the capital call.
Yeah, that's correct. And one thing that I want to point out here as well, not that, no one necessarily wants to say that there's a capital call, but and we're going to talk through some of the financial projections and some of the things we're seeing. But this $600,000 effectively gets us to what we originally underwrote the project on from a full capitalization standpoint. So the proposed prior returns were all projected off of this amount of equity, plus or minus about $20,000. And so while there is going to be a kind of an uncomfortable piece to this capital call, what we want to make sure is that when it comes to the return profile, what we're talking about is getting to just about 3.4 million, which is about what we were targeting originally on this offering. We deemed, based on some of the reserves and some of the other things that we had at the time, that we were going to be in a good position without that capital when we closed. But since then, there have been a lot of issues that have come up. And so I just want to point out that the original projections were based off about this amount of equity to begin with. And we've redone some projections based on kind of what we're seeing, the investors' hold period and kind of the struggles that have happened since then, as well as the couple distributions that we have made in this project. And we'll go over those here in a little bit, but I want to just make that point. So, and to your point again, I think at about 21% or 20.9% for a $100,000 investor, what this would look like is $20,920 infusion or additional capital commitment to the project.
And I do want to reinforce the point that our initial budget had this initial capital allocated. We undercapitalized based on our understanding of the project at the time, but those things played out more dramatically than we wanted, and so it actually went back to the original budget. So essentially, we just raised less money than we should have, based on what ended up happening on these challenges.
Yeah, in any project, there are knowns, there are known unknowns, and there are unknown unknowns. And it was the unknown unknowns that really created a lot of problems for us. Things, behind walls and behind roofs and things like that created the issues that we've since worked really diligently to resolve, but there's still more work yet to do.
And just to ask a question that an investor asked, is a capital call required from each investor?
So initially, we are going to, I think, again, based on this, we have kind of one or two more options that we're still looking at before we do that. Then from there, we would put it out to the investors to say effectively, here's what this looks like. Here would be the expectation. If not meeting this, there would be an opportunity for dilution. Other folks could come in and dilute that equity. In the operating agreement, there is some permissions in there. Effectively, if someone is not able to invest additional capital, commit additional capital to the project, then there are some mechanisms within the operating agreement, which we would spell out at this time by or before January 15th, that effectively lay out, hey, this is what the process is going to look like going forward. So in the event that someone did not fund their pro rata portion of the capital and somebody else did not fund that portion, then there is a mechanism in the operating agreement for what that looks like. It's section 3.4. And again, we'll provide more of that information on by or before January 15th.
Got it. Okay, so let's go into some of the financials.
So here's
Parker.
Yeah, so to kind of quantify the issues that we've discussed here. So we have sources and uses. So sources today, cash on hand of 119,000, insurance proceed escrow with our lender of 83,000, replacement reserve escrow of 129,000, which leaves us a gap of $575,000, which is why we're talking about a $600,000 capital call here. What that looks like, and this is on the right side here, the uses. So what we're doing there, so the first two are common area paint, common area floor. These are really necessary upgrades for us to make sure that we can have occupancies that are high and rental rates that are going to effectively maximize the value of the property. The garage assessment, the structural assessment is currently being engaged, and Norton and Schmidt is a Kansas City engineer that's working on this project. The laundry stack replacement and jetting and sewer have already been completed. There have been damages there, so we're exploring those, but they have been completed and are still required costs to expend, regardless of kind of what a settlement option might look like with the underlying contractor. On the ground floor, we have an air handler that needs to be replaced. This is one of those HVAC issues. This air handler controls the air for the ground floor and the ground floor common area and community room. And this is a necessary replacement. This has not been functioning. The risk of not doing this is that we might have pipes freeze, which is not going to be an insurable event. And so we need to make sure that we're completing that. The boiler and pumps here that we have for towers, this is scheduled and actually complete. There's been some additional work that's been done there. This was work really associated with the annual inspection, so making sure that that was operating correctly. And then on the insurance related repairs that are tied to the insurance proceeds on the sources side, what we've effectively done is assume there's a 20% shortfall, so depreciation or other things that won't be covered by the lender, but are still, issues. And so we've basically put a 20% contingency on that insurance amount here. Of the 4 claims that we have, so again, 2 of them were approved, 2 of them were denied. However, what we're accounting for here is $100,000 of insurance deductibles. We have a $25,000 per occurrence deductible. And so this is 4 separate deductibles. In the event that these things do not get pushed through, either with the resolution of the contractor or the insurer, it could be potentially more costly. But there's some other options we can explore there as well. On the 10th floor, that was mostly damaged by the water flooding from a pipe burst as well as the roof. We budgeted $10,000 per unit allowance for those 11 units, and then one of the units is covered by insurance. And then $6,000 per unit allowance we have for another 23 units at towers. Some of that work is already completed. Additional work is ongoing. Stoneybrook, 6,000 unit for 20 units. Again, we have about 11 of those units left remaining to complete. And then current payables of $81,000 and $21,000 for towers and Stoneybrook collectively. These are largely associated with other construction, repair, and maintenance items. None of the payables do not include any owed fees.
And how is that?
I'm sorry.
Thanks for that recap. And just moving on, how does the next year's budget look like?
Yeah, so this budget is based off of trailing numbers, removing some one-time items that were due to the management transition or some capital items that were above the line. And so we're looking at, effectively, there's a kind of month-to-month lease up structure here that we're working on, but you'll see here that we're pushing on a monthly basis to really get these rents up, get the leases improved. So we're looking at kind of walking into a little bit of a shortfall in the first quarter, but looking to be able to stabilize by the end of the first quarter and push those results up from there.
Okay. You want to talk about this last one slide?
Yeah, so here's some financial projections, and this is below the kind of finer print. You've got quarterly based projections, and then above here we did sort of an annual summary. And so what this does is it takes back to the acquisition date, the distributions that have occurred since, and then assumes that a $600,000 additional capital infusion will happen on by February 1st, and then the projected return profile from there as we stabilize the property, cash flow the property, and head towards a conclusion. What we've modeled here today is a 2025 exit. But again, the faster we can, have the capital, complete the work, lease the property, the faster that we can affect a sale of the property. And so our goal would be between 2023 and 2025 that we are doing everything that we can to get the property fully leased and stabilized. and then sell the property. So again, we modeled this off of a 2025 sale. We used a little bit more of a conservative set, I think, of assumptions on rental rate growth, on leasing activity, et cetera. Our goal would be to effectuate a sale as quickly as possible.
Okay, and so final slide on the assumptions.
Yeah, just a few assumptions here. So this assumes the capital needs are immediately resolved and works completed in the first quarter. The capital budget is based off the immediate needs, but does not include garage repair or HVAC replacement. So we're still waiting on what those are going to look like. This assumes we're achieving market rental rates by 2025. Obviously, our goal is to hit those in 2023. We have a 3% annual inflation factor for rent and expenses. Expenses are projected off actuals. We use a 6% exit cap rate with a 4% fee load, and then we increase the cap rate 15 basis points annually. Based on the 2025 sale, it's at 6%. The debt structure in the model is hybridized between Stoneybrook and Independence Towers. It's very close, but those are actually on 2 different amortization schedules. And then the current basis that we've modeled here is obviously fully loaded. So we put the full amount of capital that we've committed to the project prior. Those projections based off valuation, capital, et cetera, are all based off of everything that we've spent. So this includes, funds that we've used to have to cover interest carry, working capital, capital improvements, repair and maintenance. We want to make sure that we were projecting this off. So we did a projection that was based off of if we effectively bought the property today, what would projections forward look like? And then we took those numbers and we put it into a schedule based on actual investors in the deal today, looking at the historical numbers and then projecting out based off of those projections as to what the next 3 years will look like.
Thanks, Parker, for that update. So I'm going to